Thank you for joining me. I'm Alex, and I want to talk about Teladoc today. They're a company that does telehealth, which means virtual doctor visits. And obviously, in the current situation, those are becoming more and more popular. If you want to see a doctor right now, then chances are you will do like a virtual doctor visit, because the whole part of seeing patients is kind of frowned upon right now. Obviously, they can't take your blood over the internet, which is kind of a problem, but labs and doctors are fairly separated as it is. So I don't really see that as a big problem. And I don't really think that the shift to virtual doctor's visits is going to stop once the current crisis is over. I think it's more of a long-term shift, and I think that a company like this is well positioned to take advantage of that in the future. And I think obviously the shift is going to be accelerated quite a bit, and that obviously is a good thing for a company like this and other companies. There's a few other players in the area, and obviously hugely growing market. So good to start looking at that, I think. So current price is $171.77, which gives them a market cap of $12.5 billion. Dividend is zero. I don't expect that to change. Obviously, they're currently not profitable, so that makes paying a dividend very difficult. But even if they become profitable, I think it'll be at least a decade before they start even considering paying a dividend. So dividend is not something that should be considered right now. Revenue, 553 million, up over 25%, and over 2 years up over 100%. So the growth is quite significant here, and I think that it may accelerate for a couple of years. We'll see how it goes from there, I suppose. Earnings, pretty even. They lost slightly more money than last year, but they lost less money than the year before, with again half the revenue then. So things are going like not really in the right direction, but definitely not in the wrong one. Steady loss with hugely growing revenue is obviously a good thing, because it's way easier to make a profit off of like $1 billion in revenue than it is to make a profit of $500 million in revenue, quite obviously. Economies of scale are always in your favor there. So that gives them PE of negative 124. Forward PE is not listed. I would assume that they make a loss, or that they have a loss in the current year, and they might have a loss going forward, because it's probably way better for them to reinvest all the money that they can right now and then focus on making money later, which kind of has been a business model of new startups ever since Amazon kind of popularized that. Total assets $1.6 billion, slightly up. Total liabilities $589 million, up 20%-ish. Total stockholders' equity of $1.0 billion, and that is up from $1.0 billion, up under 1%. It's like 0.1%-ish. So obviously even there, not a problem really. I actually really like this balance sheet. I don't really like the earnings. I don't really like, the PE. Negative 124 is not too bad, so they're not losing a lot of money per share, but they're still losing money, so that's kind of a problem. Also, price to revenue is 25-ish, so I think it's kind of overvalued, and I think that we're going to have to watch and see where it goes from here. I think that long term, it could be a very good product, it could be a very good company, and it could be a hugely growing stock. I don't think that I'll be investing in it because there's just a long way to profitability and to a decent PE. So let's say that they have a net profit of 25%. Or let's make it 20% and then round it because I'm bad with numbers. So let's say that they make $100 million. That would give them PE of 124. If they can double that every year, then you would arrive at a PE of 30 after 2 years. And that is going to be hard to do, especially when the revenue growth is only 25% or 100% over 2 years. Still, though, I think that if your investment horizon is way long out, and obviously these growth stocks have ridiculously price to sales ratios, so obviously I don't think it's a terrible one, and I do think that they have a path to profitability. They have a path to a decent PE. And you also need to remember that even a PE of 124 is better than what Netflix has. So there's definitely potential here, and I wouldn't really invest a huge chunk of your money, but as a speculative growth stock, I think it kind of makes sense to invest in a company like this that has a huge potential in a hugely growing market with a lot of upside for the long term. So if you want to see it as a growth stock, see it as a speculative investment, throw a tiny fraction of your portfolio into this, I would not blame you. Obviously, dividend investors are out. Obviously, value investors are out. Growth investors might see a good opportunity here. That's it from me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.